Selling a property you just inherited or selling in a fiduciary capacity? As part of the process, you're probably wondering what taxes you'll owe and if the IRS is going to take a big chunk of the sale. The good news? In many cases, you might not owe as much as you think. In this video, I'll break down what actually applies when you sell property from a trust or estate so you don't lose sleep or money over the wrong kind of tax. If we haven't met, hi, I'm Andrew De Vries. I help professional and family fiduciaries sell probate and trust real estate in the San Francisco Bay Area with less stress, less liability, and for more money. I've closed over 900 of these transactions in the last 20 plus years, and with this channel, I'm here to help you avoid costly mistakes. Tax questions are one of the most common and most confusing questions I hear from clients just starting the process of dealing with estate and trust real estate. Property taxes, capital gains, estate tax withholding, it's a lot to sort through, especially if you're already managing grief, paperwork, or family dynamics. That said, while I'm not a tax professional, and this should not be construed as tax advice, the following video should give you a good basic understanding of the questions to ask your attorney and tax professional when the time comes. In this video, we'll talk about what taxes get handled automatically through escrow, how capital gains work when you inherit a property, whether estate tax applies, hint, for many people it actually doesn't, and what forms, like California's Form 593, you may be asked to fill out. Now again, this isn't tax advice. For that, you'll want to speak to a qualified CPA. But what I can give you is clarity on how this usually plays out so you can move forward with fewer surprises and a lot more peace of mind. First, let's cover property taxes due at sale. Property taxes are not estate or capital gains taxes, which are often handled after the sale. Unlike those taxes, any unpaid property tax balances are typically paid through escrow when the sale closes, with the title company ensuring that any delinquent property taxes, along with any other liens showing on the property, are cleared at close. This is because property taxes are tied to the property itself, not to you or the estate beneficiaries individually. So the estate or trust will not be personally liable to come up with that money. It just comes out of the sale proceeds. That said, there is one property tax reassessment that can come after the sale that fiduciaries should be aware of. And these are often referred to as property tax escape assessments, or sometimes just called property tax escape taxes. So what are escape property taxes? When someone passes away, the county assessor reviews whether the property should be reassessed for property tax purposes. If the transfer of ownership from the decedent to the heirs or the trust triggers a reassessment under Proposition 13 or 19 rules in California, the assessor can issue a supplemental or escape assessment to raise the property taxes base. When do escape property taxes arise? The escape tax often applies retroactively from the date of death, even if the sale hasn't happened yet. So when the estate or trust eventually sells the property, there may be a bill for back property taxes covering the months or years between the death and the actual sale of the real property. This new bill reflects the difference between the old lower tax base and the new reassessed value. So why does this matter to the trustee or administrator? Because executors, trustees, or beneficiaries are sometimes surprised to see this tax bill, since the regular property tax bills keep coming at the old rate until assessment is processed. The county then catches up with the estate assessment, and the estate must pay the difference sometimes before, but often after the closing. Now let's talk about capital gains, specifically how they work when you're selling an inherited property. This is where a lot of people start to worry about a big tax bill. But in most estate and trust sales, there's something working in your favor, and that's called the step up in basis. Here's what that means. When someone passes away and their property is transferred through a trust or estate, the cost basis of that property, what the IRS uses to calculate capital gains, is usually stepped up to the fair market value as of the date of death. Let's take a simple example. Say your parents bought a home 35 years ago for $100,000. By the time they pass away, that home in the Bay Area is worth $2.5 million. Without a step up in basis, you could be looking at a capital gain on a $2.4 million difference if you sold it today. But with the step up in basis, your new basis is $2.5 million, or the value on the date of death. So if you sell the property for $2.5 million shortly after inheriting it, there's no or little capital gains due on the sale. Even if it sells for a bit more or less, you're only taxed on the difference between the sales price and that new stepped up value. Now, a couple of caveats. If you hold the property for a while and it appreciates, you may owe capital gains on that appreciation, just like any other sale. If it's sold as a decedent's primary residence, the estate may qualify for an additional capital gains exclusion, up to $250,000 for a single filer or $500,000 for a married couple. But the property has to meet the residency and ownership requirements to claim that. It can't be a vacation home or a rental property. Key takeaway? Thanks to the step up in basis, most heirs who sell relatively soon after inheriting will likely owe little or sometimes nothing in capital gains tax. This is one of the biggest reasons to work with a real estate agent and a tax professional who understands probate and trust real estate sales. We'll help you get a proper valuation and keep the timeline and documentation clean for your CPA. Now let's cover another common tax concern: estate taxes. You might hear people refer to this as the death tax, and it often gets lumped in with other taxes people think they'll owe after someone passes. But here's the truth: estate taxes only apply to fairly large estates. As of 2025, the federal estate tax only kicks in if the estate's total value exceeds $13.99 million for an individual or nearly $28 million for a married couple. In 2026, this limit is set to increase to $15 million for an individual and $30 million for a married couple. But of course, that could change. If the estate you're managing is below that threshold, you likely won't owe any estate taxes. And if you're in California, there's even better news. California currently has no separate state estate tax. So unlike places like Oregon or New York, there's no additional tax at the state level when someone passes away. Now, for very high net worth families, there are planning strategies worth exploring, and I encourage you to speak with an estate planning attorney and financial advisor to do that. But for the vast majority of heirs and fiduciaries, federal estate tax may not apply. So if you're selling a home from a typical trust or estate in the Bay Area, this is one tax you may be able to cross off your list. Now let's talk about something that often catches people off guard during escrow: California's Form 593 and California's 3 1/3 state withholding for real property sales. If you've never sold a property through a trust or estate before, this form might raise some red flags, especially when you see the words withholding or franchise tax board on the cover. So here's what you need to know. Form 593 is part of the California real estate withholding process. It's to determine whether the state income tax should be withheld from the proceeds of a real estate sale, and in what amount. And this isn't unique to just estate and trust sales. California applies this tax rule to most real estate transactions, especially if the seller is an individual or entity that might owe state income tax on the gain. For fiduciaries, especially trustees, executors, or administrators, withholding may apply by default unless an exemption is properly claimed on the form. Some of the most common exemptions include no gain on the sale if the property is sold for no taxable gain. For example, because the step up in basis at death brought it to current value. The estate or the trust can certify this and avoid withholding. The estate or trust is exempt from the tax if the seller is a probate estate or certain trusts that are not subject to California income tax. For example, a grantor trust reported under the beneficiary's Social Security number, and they can claim an exemption. If the sales price is under $100,000, this will automatically exempt the sale from withholding, transfer to an exempt entity. If the buyer is a government agency, tax-exempt organization, or similar exempt transferee, withholding doesn't apply. Loss or zero gain certainty. The fiduciary can check a box that the transaction will result in a loss or zero gain, most common when a property sells soon after market value, and this will exempt you as well. All that said, you want to make sure your CPA or tax attorney reviews the 593 form with you before submitting it to the title company, and the title companies will typically require this form before they can disperse the funds. So while it's just one more form in the stack, it has real tax consequences if handled incorrectly. Don't guess. Get professional input. Finally, one of the most common questions I hear from clients, especially when capital gains calculations are involved, is as follows. What can we deduct expense-wise from the cost of sale to lower the tax burden? The good news is, when calculating potential gain on the sale of a trust or estate property, or a loss, you can subtract certain transaction-related expenses to reduce the taxable amount. Here are some of the big ones. Number 1, improvements made to increase the sales price, such as repairing the roof, painting, or landscaping for curb appeal. 2, real estate commissions. These are fully deductible when calculating a gain or a loss. 3, title and escrow fees, including recording fees. These are standard in California and can also be claimed to reduce your net proceeds. Number 4, transfer taxes. Depending on the city, these may be paid by the seller and can be deducted. Number 5, legal or accounting fees tied directly to the sale. If your attorney, CPA, or fiduciary is working on the sale transaction itself, those costs may be deductible as part of the expense of selling. What you typically can't deduct are things like ongoing trust administration fees, unrelated legal expenses, or improvements made after the date of death unless they directly contributed to preparing the property for sale. The goal here is to determine the true gain for the sale after all legitimate transaction costs are accounted for. And if you're working with a CPA, which I strongly recommend, they'll help you pull together a clear summary of those expenses as part of your final reporting. Again, the good news is that many of the major costs you might expect, agent commissions, title, escrow, transfer tax, and sale fix-up fees, are likely deductible and help to reduce what you might owe in capital gains. Now, before we wrap up, I want to emphasize something really important that I mentioned at the beginning. This video is not tax advice. Every estate, every trust, and every family situation is different, especially when you start layering in things like surviving spouses and a partial step-up in basis, past partial transfers to adult children or other family members, how long the property was held after the date of death, whether the property was rented, improved, or partially gifted. These are the kind of details that can significantly impact what taxes, if any, apply to your sale. That's why it's so important to involve a qualified CPA or tax advisor, especially when you're handling an estate or trust with real estate involved. The good news is, with the right strategy and the right people around you, you can move forward with clarity and confidence. And as part of that, I help fiduciaries and families sell probate and trust real estate across the San Francisco Bay Area with less stress, fewer surprises, and a focus on getting it right the first time. If you have questions about timing, valuation, or how the sale might impact your tax picture, please call me directly to schedule a confidential consultation. And if you found this video helpful, please subscribe or share it with someone else who might be going through the same process. The goal is simple: clear answers, fewer missteps, and better outcomes for everyone involved.